Welcome, everyone. Today, we're diving into a powerful trading strategy that leverages the Fibonacci tool, a method used by seasoned traders to identify high-probability entry points, manage risk effectively, and capture larger price movements. Whether you're new to trading or looking to refine your skills, this guide will break down complex concepts into simple, actionable steps. By the end, you'll understand how to use Fibonacci retracement strategically, avoid common pitfall, and combine this tool with other techniques to boost your confidence in the markets. Let's begin. Understanding the Fibonacci sequence, the foundation. Before applying Fibonacci to trading, let's explore its origins. The Fibonacci sequence is a series of numbers discovered by an Italian mathematician centuries ago, starting with 0 and 1. Each subsequent number is the sum of the two preceding ones. 0, 1, 1, 2, 3, 5, 8, 13, and so on. The fascinating part? When you divide a number in the sequence by the one that follows it, the result consistently approaches 0.618 ratio, known as the golden ratio. This ratio isn't just a mathematical curiosity. It appears in nature, architecture, and art, reflecting patterns of balance and harmony. Traders later realized price movements in financial markets often respect these ratios too. By plotting Fibonacci retracement levels on a chart, we can identify potential areas where prices may reverse during a trend. Fibonacci in trading, the basics. Fibonacci retracement levels 0.236, 0.382, 0.5, 0.618, and 0.786 act as potential support or resistance zones during price pullbacks. Here's the key insight. Shallow pullbacks, 0.382 or less, indicate a strong trend. Prices reverse quickly, suggesting buyers in an uptrend or sellers in a downtrend are aggressive. Deeper pullbacks, 0.5 to 0.618, known as the golden zone. This area signals a mature trend. Prices may consolidate here before resuming their direction. Beyond 0.618 suggests a potential trend reversal, as the pullback is too deep to fit a healthy correction. Many traders make the mistake of focusing solely on the 0.382 level, expecting trends to stay strong. However, markets rarely move in straight lines. The golden zone, 0.5 to 0.618, offers a more reliable area to plan entries, as it balances probability and reward. The number one mistake traders make with Fibonacci. The biggest challenge isn't understanding the ratios, it's selecting the correct swing points to draw Fibonacci retracements. Choose the wrong points, and your analysis becomes unreliable. Let's fix that. Step 1. Identify the trend. Always trade in the direction of the trend. Uptrend, prices make higher highs and higher lows. Downtrend, prices make lower highs and lower lows. Step 2. Locate the impulsive move. Look for a strong, sustained price movement in the trend's direction. This is called an impulsive wave. In an uptrend, this is a sharp rally from a swing low to a swing high. In a downtrend, it's a steep drop from a swing high to a swing low. Step 3. Draw Fibonacci retracement correctly. Uptrend, anchor the tool at the swing low and drag it to the swing high. Downtrend, anchor at the swing high and drag to the swing low. This mechanical approach removes guesswork. The golden zone, 0.5 to 0.618, becomes your focus area for entries. Strategy 1. Swap zones plus Fibonacci confluence. Fibonacci works best when combined with other tools. Enter at swap zones, a concept where broken support becomes resistance, and broken resistance becomes support. Here's how to use them. By trade example, identify an uptrend. Prices are making higher highs and higher lows. Spot a resistance level. Notice where prices previously stalled, a swing high. Watch for a breakout. When prices surge above this resistance, it becomes new support. Draw Fibonacci. Apply the retracement tool to the impulsive wave post-breakout. Wait for confluence. If the golden zone aligns with a new support, This is a high probability buy zone. Prices often bounce from this confluence, offering a low-risk entry with a tight stop-loss below support. Sell trade example. Identify a downtrend. Prices are making lower highs and lower lows. Spot a support level. Mark where prices previously reversed upward, a swing low. Watch for a breakdown. When prices crash below support, it becomes new resistance. Draw Fibonacci. Apply the tool to the downward impulsive wave. Wait for confluence. If the golden zone overlaps with new resistance, expect sellers to dominate. Prices often reject this zone, creating an opportunity to sell with a stop loss above resistance. Strategy 2. Trading impulsive moves and pullbacks. Markets move in waves. Impulsive surges follow by pullbacks. Your goal is to enter at the end of a pullback, just as the next impulsive wave begins. Here's how Fibonacci helps. In an uptrend, after a strong upward move, prices retrace. Draw Fibonacci from the swing low to swing high. Look for bullish reversal signals, e.g., candlestick patterns, volume spikes, near the golden zone. Enter long, placing a stop loss below the 0.618 level. In a downtrend, after a sharp decline, prices retrace upward. Draw Fibonacci from the swing high to swing low. Watch for bearish signals, e.g., rejection candles, near the golden zone. Enter short, with a stop loss above the 0.618 level. Pro tip: in very strong trends, prices may only retrace to 0.382. Use this level cautiously, and only if the trend is undeniable, e.g., breaking news or strong earnings forecasts. Enhancing your strategy, additional confluence. While Fibonacci is powerful, combining it with other tools increases success rates. Trend lines. Draw lines connecting swing highs/lows. A pullback to Fibonacci plus trend line equals strong confluence. Moving averages. Use a 50 or 200 period MA. If prices bounce near both the MA and golden zone, confidence grows. Price action. Watch for pin bars, engulfing patterns, or volume surges at key levels. Common questions answered. Why does the golden zone work? It represents a fair value area where institutional buyers/sellers re-enter trends after taking profits. What if prices break below the 0.618 level? The trend may be reversing. Exit the trade or tighten your stop loss. Can Fibonacci predict exact reversal points? No tool is perfect. Focus on zones, not exact prices, and always use stop losses. Let's walk through a recent trade. A currency pair is in a clear uptrend, higher highs and higher lows. Prices rally sharply from swing low to swing high. Prices dip to 0.5 level, then 0.618 level. Anchor at swing low and swing high. The golden zone is 0.5 to 0.618 level. The 0.618 level was prior resistance, now support. Enter when a bullish hammer candle forms within the golden zone. Enter long. Exit when prices surge to swing high, yielding profits. Final tips for success. Patience is key. Wait for clear setups. Not every pullback is worth trading. Risk management. Never risk more than 1 to 2% of your capital per trade. Use historical charts to test this strategy. Note how prices react to Fibonacci levels. Thank you for joining us in exploring this proven approach to trading with Fibonacci tools. If you found this guide helpful, consider subscribing to our channel for more in-depth strategies. Feel free to drop questions in the comments. We're here to help you grow as a trader. Until next time, happy trading